The financial markets have run quite a bit in '09, both debt, fixed income, as well as equity. And in addition, we've seen a capital exodus to some of the emerging nations, and their financial markets have responded, and their currencies have responded. What is your sense at this point? Has this run its course, or is there enough continued liquidity to continue to propel it even further, even at these prices?
Well, I think what's going on, and again, it's not totally knowable because there's always unknowns within every market, but there's sort of two issues. One is the technical side, and the other is the investor side. Take the second one first. The investor side is starting to take the position that, based on sentiment and other things, that the growth rates in the developed world, Western Europe, the United States, and Japan, are going to be subpar for quite some time because they're working off the debt and so on and so forth that we've been referring to. And that sentiment is probably grounded in some degree of reality. When you're trying to work off the amount of debt that's accumulated in the developed economies, the growth rate is probably going to be hindered. Not to mention other factors. Demographics are better in the emerging markets than they are in the Western economies. The pension systems are a drag on the Western economies. Taxes are higher. Regulation is more. So there's good reason to basically, on a fundamental basis, to believe that. The thing people need to be careful about, which is sort of the same thing as like internet stocks, is yes, the internet was a wonderful thing, but you can take a wonderful thing and take it too far. So that deals with sort of the fundamental. The other issue is that most of the developed emerging markets are on what we call a de facto dollar standard. East Asia, in particular, basically they tie their currency to the US dollar. And when a country ties its currency to another country's currency, that country has in effect imported the central banking decisions of the currency that they've tied to. So in the case, for example, of China, China has tied its currency to the United States' currency. And so therefore, it's in effect tied its central banking policy to the Fed's central banking policy. This causes an enormous number of complications. And now there's good reason for it in the sense that these are countries generally that don't have institutions that are robust enough, central banks and so on and so forth, that they feel that can handle the process of managing a monetary system. They also don't have deep fixed income markets and so on and so forth. So there's logic to that decision. But the problem you have is that sometimes the monetary policies of the country who you've tied your currency to is totally inappropriate for your own country's circumstances. And that's really where we are right now. So over time, that issue is going to have to be reconciled. For now, where you know that the Fed is going to continue to keep interest rates at incredibly low levels and continue to provide massive liquidity, I think it's fair to say that the emerging markets are going to be, particularly East Asia, are going to be massive beneficiaries of this because they have very large growth rates against very low interest rates, which is, frankly, is a prescription for an asset bubble. So if you're looking for the next bubble, that's probably where you're going to see it.
So you'd say the emerging markets are not done yet? What about countries like Brazil that are now trying to resist capital inflows?
Well, and that's smart, and you're going to see more things like that. I mean, China, first of all, doesn't have convertibility. They've walled off the country. To bring money into China, you have to get approval from the local central government there, SAFE, the institution there. And Brazil is basically saying the same thing. Can we institute some regulatory policies, whether it's a tax of bringing in money, so that we can try to manage the inflows, the capital inflows that's chasing this yield. The problem is that, it's like sticking your fingers into, a dam. There's just so much money that wants to go to these places that, for example, the 2% tax that was announced last week in Brazil, that day Brazilian stocks were down 3 or 4%. But the following day, they just went back to where they were. So I think that the emerging markets are going to have an enormous challenge of trying to maintain a policy of de facto tying their currencies or their interest rate policies to the United States while at the same time trying to make sure that they don't create bubbles within their own countries. And whether or not they're able to manage that, I think remains to be seen. But it's certainly something that global investors need to be attuned to.
Now, can I ask you, at this point, with so much liquidity and continuing to flow, are you following the money, or have you become a contrarian?
Well, I think that you have to, there's no one answer to that question, because, I mean, for example, you could have taken the position that you were going to short housing stocks in 2004. If you had done so, you would have been, it would have affected your performance in a very negative way. So what I would tell you is that in December of '08, we were much more confident in many ways about taking risk, buying risk, directional risk. I'd say today we're not nearly as confident of that, because I think that prices have moved so far, so fast, that it's much more difficult to maintain biases in your directional investments. Now, there's many ways to deal with the issues you're talking about riding the wave and when to get off, whether it's trading with very tight stops,
And
or
whether to
it's,
bet against it.
yeah, or it's hedging, or so on and so forth. But I think that generally investors, unfortunately, have a tendency, in both cases, they see bubbles too early, okay, and they want to short those bubbles. And then there's a point at which they throw in the towel and they say, well, forget it, I'm not going to go against the bubble. And probably that's probably the point at which they should be on the other side of that bubble. So I think what we look for is we try to basically manage the book in a way. We're managing risk. So we're not trying to put ourselves in a position where, unless we feel that we're really at extreme tails, and we don't think we're at extreme tails right now. If we think we're at extreme tails like December of '08 on the upside, or '07 on the downside, we'll be more directional. But usually in the middle, extreme bubbles take some time to build up. So to answer your question, I think, between hedging, tight stops, having a very diversified book, a lot of dispersion in your portfolio, good risk management, I think you can generate good returns right now. But I do think that you certainly should be far more cautious about asset prices today than you were 9 months ago. I mean, I don't think that's a question.
Well, could you comment on some of the astounding PEs that exist in the market, in the equity markets, and the tight spreads in the fixed income markets?
Well, equities are an interesting issue. I mean, I think they're somewhat mutually exclusive. I mean, PEs tend to, after a big drawdown in profits, tend to look very high at a trough point in the economy. So you have to look at normalized PEs, right, on a rolling basis, so that you don't get into a situation like in 90, 91 or 01, 02, where the PE appears very high, but that's coming off of a very low profit number. I'm not suggesting I think the stock market is undervalued or overvalued by that comment, but I think sometimes people look at a nominal number and they try to make a definitive decision. I think stocks are, I think clearly there's been euphoria in liquid markets, and I think that it's amazing how quickly we've gone from one extreme to the other. But I think that people need to be careful about making overgeneralizations about stocks. I think that stocks are probably, over time, they tend to track the economy. And I think, at 600 on the S&P, which is where it was March 3rd, it was certainly very easy to say that this looks very cheap. It's not so easy to say that stocks look cheap here. That's fair. Credit spreads are a very different animal. Credit spreads have benefited probably even more than stocks have from the liquidity provisions at the Fed. And I think that's a place that people should be very careful, because I think you're in a position now, where spreads are unusually tight. I mean, they're far tighter than they were even before Lehman Brothers had its problems.
Adam, we appreciate very much your coming, and we very much appreciate your views and your illumination of the issues, which sometimes are very much more difficult to see in academia than in the front line as you are.
Thank you for having me. Appreciate it.